Since the last video in this series, I'm sure many of you have been aware of what has happened in the markets. From the end of February until the aftermath of Liberation Day, we saw the S&P 500 drop 16.32% until it bottomed out. For the Nasdaq over that same period, it also dropped 18.17%. Now only a month afterwards, with some tariff pauses and deals, both the S&P 500 and the Nasdaq have basically recovered all the losses from April 2nd. Up until now, we haven't seen quite a test for these covered call ETFs through such a big drawdown, so this will be a great way to see if they're able to recover and get back to an outperformance of the underlying indexes. Before we get into the video, this is the most popular series on the channel. It takes a considerable amount of time to put together. So if you want to continue following along, feel free to like and subscribe to help out the channel. The goal for this year is 2,000 subscribers, and we're almost halfway through the year. Thanks in advance, and now let's get into the comparisons. To quickly summarize the details of these comparisons, the intent is to see how these diversified leveraged cover call ETFs can compare in performance to their traditional growth index counterparts. While it may make more sense for some investors to invest in the index and eventually sell off holdings in retirement, there are some who want to be more hands-off. It can be daunting trying to figure out all the details for retirement and the withdrawal strategies you should take when the time comes. That is where this income strategy comes in and removes that need to monitor and time when you should sell. It's much more passive, where you can receive a stable, consistent dividend and can stay fully invested in the market at all times. So the first detail for these comparisons is that we'll be focusing on only enhanced cover call strategies, which means that all these funds use a modest degree of 25% leverage. Then with these comparisons, we'll cover all the major indexes, from the S&P 500, the Nasdaq 100, and the TSX 60. With the S&P 500, it'll be VFV, USCL, and USSL, and then VSP and HYLD. For the Nasdaq 100, it'll be QQC, QQCL, and QQQL. Finally, the TSX 60, it'll be XIU, CNCL, CANL, and HDIV. These are all separated into different groups because of the currency hedging aspect of these ETFs. What this means is that if a fund is traded in Canadian dollars but is not currency hedged, this means that all the holdings and activities are done in US dollars. So if the Canadian dollar starts to weaken against the US dollar, the overall value of the fund will see an increase in performance due to the exchange rate. If the Canadian dollar starts to strengthen against the US dollar, then the opposite will happen, where the unhedged ETFs will underperform due to the exchange rate. For the funds that are currency hedged, it means that the fund will be converting the values back to Canadian dollars. This will then essentially try and remove any influence on the fund's performance from the exchange rates with the US dollar. If you want a much more detailed explanation with examples, feel free to watch the previous video after this one to get a better idea. Now taking a look at the charts, these comparisons are going to be very straightforward and as simple as possible, and the first one will be purely based on the stock price itself. And then the second comparison is just simply adding the dividend distributions that have been paid out to shareholders back into the fund. This is because when the ETF pays out a dividend distribution, it comes from the fund's earnings being transferred to its shareholders. So by adding back the dividend distribution, it'll give a sense of what the total return would look like if those earnings were retained in the fund. Now that should be all the details for these comparisons. And next I'll share a quick thought about how we should approach performance when comparing actively managed funds. This is a thought that I want to quickly go over, and why it is that I review starting from both the year 2024 and 2025, instead of just choosing one of them to help simplify things for myself. I started investing into most of these funds at the beginning of 2024, so for myself, the performance of these funds from the start date makes the most sense, because that is what is relevant to my own investments. And for those of you who have followed since the start of this series, I'm assuming it will be the most relevant to you as well. But for those who are new or just starting out, a comparison from the start of 2025 might be more accurate. So where am I going with this? When it comes to comparison of funds, it's always great if there's historical performance to pass judgment on. But for these cover call ETFs, which have active management as part of their income strategies, it might not always be a fair reflection. While on the surface, the prospectus and the outlines of these funds may seem identical, it's the fund's active management and underlying option selection that can cause one to do better or worse than the other. And this is why I would say that past performance for these funds might not reflect the same in a future scenario or situation. These are not the same as a passive index fund, which is systematic in management, and that the active component is under the discretion of the fund manager at that point in time. So it's important to realize for these actively managed funds, they may not perform the same way in every situation. Which goes back to the original point, why I believe you should look at the recent performance of these funds from the period that's most relevant to your own investing, and not just since the fund's inception date, for example. Now, like I mentioned in the introduction, this is definitely the steepest crash that these ETFs have experienced since their inception. But last year, in 2024, we also experienced a quick decline of 8.49% over the course of 2 weeks in the S&P 500. In that same time period, the Nasdaq also saw a drop of 13.58% over the course of a month. Despite this, the cover call ETFs recovered and still ended the year outperforming the underlying indexes. So it's no guarantee that the outcome will be the same this time around, but it's just something we'll have to see at the end of the year. Now, starting with the S&P 500 comparisons, and for the beginning of 2024, we will see the 4 different lines. This first chart is just looking at the stock price return, so it doesn't include any dividends that have been paid out. Because of the currency hedging mentioned earlier, we'll look at just the comparison of VFV and USCL together. We see that the two lines begin by staying closely aligned at the start, but as the time goes on and more distributions are paid out, the two lines will eventually start to diverge. This is normal and is exactly the reason why you can't just look at the stock chart by itself in order to judge an income ETF. So there's nothing in particular that stands out on this chart that isn't expected. There is one thing I would like to point out though, about the experience of holding a cover call ETF like this through the latest decline. And this is also true for investors like myself who started positions in 2024 as well. If we look at the most recent months and compare the two lines, we can see that the cover call ETF actually dipped below where we had started in January 2024. The reason for this is because the bulk of the returns from these ETFs are from the dividend distributions, which is not represented when just looking at the stock price chart. In contrast, as we see with VFV, it will still experience the same decline, but because the gains of a growth ETF are unrealized, those investors will not see the same negative unrealized returns in their portfolio. So while it can be disheartening to see your unrealized capital be erased and turn red, remember it isn't all negative. That's because the benefit of monthly distributions is that you can use the dividends to average down and accumulate more shares, while a growth investor would have had to deposit new capital in order to average down. And now that we've seen a recovery lately, your income would also be increased as a result of purchasing those cheaper shares. So hopefully you are purchasing more shares at these lows, and that you didn't panic and sell out when you saw all the capital being erased. Taking a look now at the VSP and HYLD comparison, we see much of the same, except for how the decline of HYLD was further than all the others. This is likely because HYLD is not actually an exact representation of the entire S&P 500 index as a whole. Instead, it replicates it with a more concentrated selection of stocks that are broadly similar to the index. So because of this concentration, it can be a bit more volatile to a degree, where we can see it decline further, but also rise higher than the other ETFs. Okay, let's now scroll down to see how these have performed on the total return chart. The first thing you'll notice is how the lines are much closer now that the distributions have been added back into the price. And remember how I mentioned earlier in the video, the example from 2024 where we saw both indexes pull back in July? Well, that was actually the bottom and the start for the cover call ETFs in USCL and HYLD to outperform the indexes for the rest of the year. And thanks to that buffer, it's helped both USCL and HYLD weather the storm through all this recent tariff news and maintain a similar performance to the indexes. But with the recovery now starting similar to last year, we're potentially seeing it repeat again, where USCL and HYLD are leading the indexes from the bottom of the pullback. We'll just have to wait and see in the next update if this holds true. If we look at it with a different source to confirm, we see similar values, where for USCL without dividends reinvested is just slightly under VFV by 0.16%. Then with dividends reinvested, it's closer and just slightly under VFV by 0.08%. With HYLD, we see that without dividends reinvested, it's above VSP by 0.51%. Then with dividends reinvested, it's still ahead of VSP by 0.43%. So both of these at worst are still performing in line with the underlying indexes, and showing potential to continue their outperformance in this recovery. Now that was for those who invested at the start of 2024 like I did, but now let's take a look at what performance would be if you started in 2025. Similar to the previous chart, at the beginning these would be closely aligned until the dividend distributions start getting paid out. Here I've also included USSL, which is also the index, but with 25% leverage and no covered calls. There's not much to say in the first half of the chart, but what stands out in the most recent months is how HYLD is currently ahead of USCL, and actually VSP is ahead of VFV as well. To explain this difference is likely to be answered if we look at the exchange rate in those months. If we look from the start of March until the end of April, the Canadian dollar has actually strengthened by 4.62% when compared to the US dollar. So that sort of confirms the potential impact currency can have on the performance. Then, to further illustrate this, it's not going to be exact, but if we look at the difference between VFV and VSP, we'll get 3.6%. If we now take the change in exchange rate from January 1st to the end of April, we'll get approximately 3.95%. So this difference in performance could be a case for why you might want to consider having both HYLD, which is Canadian dollar hedged, as well as USCL, which is unhedged, to balance out the returns. Again, remember that both of these have different approaches in what they hold as the underlying, and also have different fund managers. So it can be seen as a slight form of diversification as well by having a position in both of these. We can now scroll down to see the total return chart, and specifically look at the VFV, USCL, and USSL comparison. Here, the three lines have been quite close to start the year, and then in this recent decline is where there's starting to be a little bit of separation. It's not by much, but VFV is currently out ahead by approximately 1.65% from USCL, and then USSL is in third. The reasoning for this gap is likely due in part to the leverage being used by USCL and USSL, as you can see the separation begin once the decline slowly starts at the beginning of March. If we confirm with a different source, we get confirmation that without dividends reinvested, USCL is behind by approximately 1.47%. Then with dividends reinvested, it's down a little bit more by 1.81%. So for this, we'll have to say that both the leverage ETFs are currently behind slightly since the start of 2025. We'll just have to see in this recovery if the leverage can also work in the other way, where they're able to catch up and move ahead of the index. Looking at the VSP and HYLD comparison now, we can see that at the beginning months, HYLD was actually outperforming the index for a while. But since the decline started, it's moved below the index and as of now is down by approximately 0.5%. Again, this is likely due to the concentration of holdings and the leverage being used. If we look at the returns on a different source, we can see the same results, where HYLD is behind VSP by approximately 0.91% without dividends reinvested. With the dividends reinvested, it's behind slightly more at 1.1%, and that's probably because those reinvestments were made at the highs before the decline started. So once again, the leverage cover call ETF is behind slightly, and we'll just have to see if it'll be able to recover and get ahead again. It'll also be interesting to see how the exchange rate will affect the performance for this year. As we know last year, the US dollar was a big contributing factor for the unhedged ETFs outperforming. As of now, it's made an impact, with both VSP and HYLD outperforming VFE and USCL. Let's move on now to the Nasdaq comparisons. First, with a price return comparison since 2024, we see a similar experience as the S&P 500 ETFs, where the capital return dipped just below the starting point, but then is now recovering. Other than that, this chart looks as it should. There's one thing I did point out in the previous videos, and it's the same for all these other comparisons as well. Because it's a little clearer with this chart, I'll use this as the example. But overall, it's the notion that the periods where the price is relatively flat or moderately positive is where these cover call ETFs shine the most. This is because the chances of getting shares called away or capped is lower, and we can just continue collecting the premiums. If we just look at this section at the beginning of the chart, and then the section starting from the middle where it is relatively flat, these are the periods where QQCL has outperformed the index. We can confirm if we scroll down and highlight those exact same sections. We'll see that the gray QQCL line indeed does move ahead of the blue QQC index line. It's not until we see dramatic spikes or dips in the market is where we have the outperformance start to be erased. So it's not a guarantee, but if things start to settle after this recovery, then there's a chance that cover call ETFs could start to outperform again. As of now though, since the start of 2024, QQCL appears to be ahead of the index in performance by about 2.29%. To confirm it with a different source, without dividends reinvested, it shows QQCL ahead by 1.59%. With dividends reinvested, QQCL is ahead even more by 1.7%. So those who have held QQCL since 2024 should be quite happy with this clear outperformance over the index. Now, let's see how it has performed so far since the start of 2025. Here again, I've included QQQL, which is the 25% leverage version of the index. Overall, nothing seems to be out of the ordinary here, and seems to be expected with the index being out on top. The other two are down either because of the distributions being paid out or due to the leverage. Scrolling down to see the total return chart, it looks the same except with the distributions added back. Currently, QQC is ahead of QQCL by 1.77%, and then QQQL coming in third. It seems like these leverage growth ETFs will need some more time to catch up, and for us to see if the leverage helps out in both directions. When looking at this with a different source, without dividends reinvested, QQCL is behind by approximately 1.54%. With dividends reinvested, it's behind a little bit more at 1.93%, so it's not too far off, and we'll just to see if QQCL can catch up in the next update. Finally, let's get to the TSX comparisons now. Starting with the price comparison since 2024, we see a very clear separation between all three of the lines. If you're new to the series, it's worth pointing out that HDIV is not a fair comparison when it comes to this. That's because a fair amount of HDIV is actually holding US stocks, but because it's still mostly Canadian holdings overall, is why most people see this as the closest index for comparison. So that's just one thing to keep in mind when looking at the performance on these charts. I've done a full breakdown in a previous video in this series, which you can watch after this. Other than that, there isn't anything new to mention other than what I've already highlighted in previous comparisons, so we can now scroll down to look at the total return chart. Here, it doesn't come to any surprise that HDIV is a clear winner when it comes to the majority of this chart, due to the underlying US holdings in the ETF. In the recent decline, it seems that most of the outperformance has been erased, and is just only slightly ahead of the index currently by 0.34%. If we look at it with a different source, it shows HDIV slightly behind by 0.55% without dividends reinvested. With dividends reinvested, it actually comes out slightly ahead by 0.08%. Then when it comes to CNCL, if you watch past videos, you'll know that it's only one in the series that has been underperforming the respective index. I don't own this one and haven't kept an eye on why this is the case, but it's currently behind by 4.81% since the start of 2024. To confirm with another source, we have CNCL behind by 6.46% without dividends reinvested. Then with dividends reinvested, it's a little bit better, being behind by 5.86%. This has been a consistent underperformer almost from the get-go, and looks to have a difficult time ahead if it wants to catch up to the index. But maybe a new year in 2025 will give it a fresh new start and a change in performance. So let's head over to the 2025 spreadsheet and take a look. Here again, I've added the leveraged growth version and CAN-L to the comparisons. For the price return, it looks much of the same, though it's worth noting that CNCL, HDIV, and CAN-L have all performed nearly identically so far. This is a little surprising considering the difference of holdings with HDIV containing some US stocks. If we now scroll down to the total return chart, it doesn't actually change too much. The only difference is that they are all close to the index in performance now, but still all very close together. For HDIV, it's currently behind by about 1.78%, and for CNCL is behind by about 2.28%. Then in third, just like all the other leveraged growth ETFs, is CAN-L. Looking at these with a different source, we'll see for HDIV it's behind by about 1.98% without dividends reinvested, and with dividends reinvested, it'll be behind by about 2.08%. Then for CNCL, without dividends reinvested, is behind by about 1.37%. With dividends reinvested, it's then behind by about 1.42%. So unfortunately, it seems that CNCL looks to still be trailing behind the index, but we'll have to see in this recovery how it performs going forward. Now lately, I've been working on some more dashboards that are tailored specific to the indexes and all the individual sectors for easier comparison. I have a few of these done right now, but we'll need a bit more time to put together the other ones so that they can all be ready at the same time. The benefit of these dashboards is that I've already gone ahead and done all the research and separating and organizing all the ETFs into their correct categories in the spreadsheets. This is first by the currency hedging of the ETFs, and then down to their individual strategies, such as for growth, covered calls, and leverage covered calls. The intent is to be able to see at a glance the total returns of all these ETFs in order to get a better sense of their performance relative to each other. That way, you can get a sense of which option might be best for you to either start a position in or to consider switching if you notice a better performance with another ETF. It's also a great way to monitor performance of these strategies and get a feel for how they move on a day-to-day basis because they're all in one sheet. So currently, these are set to start from January 1st of 2025, and you can see that both the leverage covered call ETFs are slightly behind the indexes. If we were to change the dates of these to January 1st in 2024, it'll then update all the values for us to see the new total return. We can see that this is consistent with our comparisons, where they're just slightly behind the indexes they are being compared to. So let me know below in the comments if this is something of interest to you and can find useful for your own investing. If you want to help support the channel, feel free to like and subscribe for future videos and the news on the release. Thanks for watching, and I'll see you in the next video.